Everybody. Today, let's talk about Burlington Stores stock. So it was up almost 21% on Tuesday. Really good day for the stock. And I'm going to look at, why it's been doing so well and whether it's worth investing in. So disclaimer, I don't have any positions in the stock. I'm just covering it to see, why it's doing so well and if something's happened recently to make it a good buy. So let's go over to Market Watch here, where it tells us that the company beat earnings expectations. It says November's off to a solid start, and as you can see, it was up 21% as it sets targets for the next 5 years. So obviously, a big long-term picture that the company painted that obviously investors viewed favorably. So overall net income tripled, it says, to 48.6 million. So that's obviously always a positive sign. And adjusted EPS 98 cents, beat expectations of 97 cents. So that's always a positive. Total revenue was up 12.2% to 2.29 billion. And same-store sales growth, always an important number for retail, was 6% and beat expectations of 5.9%. So not huge beats, but overall still pretty good. Another important number for retail is gross profit margin. So 43.2% versus 41.2% previously. So that's a good improvement, a couple percentage points there. And merchandise inventories fell. So that's an important one for retail, just because some retailers have been struggling with holding too much inventory due to supply issues, due to low demand. So that's a really good indicator that Burlington Stores, which is an off-price retailer, is doing well and improving on its margins, not holding too much inventory. So overall seems to be pretty good. And again, mentions that November's off to a good start. And for the fourth quarter, it says EPS of 304 to 319, but that's below the consensus 321. So that's a little bit underwhelming. And sales are expected to increase 5 to 7% from last year. And the consensus was 3.03 billion revenue, implied 10.6% growth. So not overly positive on the fourth quarter, which is a bit surprising given the stock was up 21%. But here's, I think, what the key thing is on the earnings call, it said the company offered its first look at 2024 and long-term targets and said in the next 5 years, it's expecting to grow sales to 16 billion, which averages out to a growth rate in the low double digits. So double-digit growth is pretty solid for retail, especially when you're talking about a 5-year stretch. So that's pretty encouraging for retail for sure. And more importantly, also, it says that operating income is going to grow to 1.6 billion, and operating margin is going to be 10%. So operating margin is a really important metric because if the operating margin isn't strong, then it's going to be difficult for the company to turn a profit. And the fact that that's improving is a solid thing. Now, one thing to keep note of here is that a big part of the growth is coming from opening new stores. So it says it's planning to open 500 net new stores in the period, and most of them are really large, 25,000 square feet in busy malls. So this is a business that's really betting on a lot of in-person shopping, a lot of return to normal type of spending, and that might be a bit risky with a possible recession heading next year. And so overall, it's going big on that, and that could potentially introduce some additional risk there for the company, because if it's hinging on that, a lot of its growth is depending on that, then it could underwhelm and possibly not meet those aggressive growth targets that it has. But it says it expects annual same-store sales growth in the mid-single digits again, which is pretty good, and compares with an average of 3 to 4% before 2020. So overall, it's saying that it's relying on higher merchant margins, lower markdowns, lower freight expenses, lower freight rates. So overall, all the things that before 2020 were sort of normal is it's counting on better margins and more of a return to normal in that. But the interesting thing is, even though it's forecasting a lot of growth over a 5-year period, it says for 2024 it's adopting a more cautious tone, given obviously economic, political, geopolitical uncertainty. So it's a bit interesting that on a 5-year period it's pretty optimistic, but on 2024 it's not. So I mean, it's a bit interesting that it would make such a forecast, especially when same store sales growth is only going to be 2%, and same store sales growth is an important number because it excludes new store openings and excludes stores that have been closed down. So you're really just looking at an apples to apples comparison. You're looking at stores that were open 12 months ago. So those stores, the company's saying, are only going to grow at a rate of 2%. So it's a bit underwhelming. So it just seems a bit odd that in the short term they're expecting some challenges, but in the longer term, a bit more optimistic. It's a bit odd. And so analysts at Jefferies put a buy rating on the stock, expecting it to go to 195. So that's pretty high. And even with the company's stock jumping today at 165, that's still $30 higher than where it is. So I mean, they're still bullish that it's going to go even higher. Now let's look at the actual press release here from Burlington. So again, reiterating some of the same sort of things that we saw already. So comparable sales 6% versus this guidance of 5 to 7%. That's solid. So it had some expenses due to the acquisition of Bed Bath Beyond leases that impacted its earnings, but overall adjusted EPS 110 versus 97 to 112. So again, well within the range, doing a fairly good job of forecasting. That 6% comparable sales, same store sales growth is a pretty good number. The one thing though that again is worth noting is that it says for 2024 working assumptions for total sales growth of approximately 11% versus 2023. But the key thing to note here is this is driven by our expectations for 2% comp sales growth plus 100 net new store openings. So what that tells you is that the company is expecting its sales to jump by 11%, but that's mainly due to these new store openings. Because if only 2% is coming from comparative sales, that means existing stores are only going to add or only going to grow by 2%. The rest of it's going to come from new store openings. That paints a bit of a different picture, right? And because if you're opening new stores, that's more overhead, that's more general admin costs, more expenses onto the income statement versus if you're just growing organically because there's more traffic coming to your stores because consumers like your stores more or you redesigned it. So it puts it into a different perspective because it's not just sheer organic growth that is driving this. It's benefiting from new store openings. So it's just something to consider because it seems like that's a big part of the company's strategy is launching more locations. And so if we go down here, further down, see if there's anything else. So overall, merchandise inventories, again, we have that 8% decrease. Seems to be solid. Or repurchasing common stock, always a good sign that that the company is doing well, that it can afford to buy back shares. And it says for full fiscal 2023, sales to increase 11%. And on top of a 7% decrease in 2022, comparable sales stores will increase approximately 3% on top of 13% decrease from fiscal 2022. So a bit of a bounce back for Burlington this year. Again, opening 80 net new stores. So it's overall, it doesn't seem like to be an overly strong year, but I guess it's an improved one from the previous one, so that's a positive for investors. What's interesting again is we look at the fourth quarter of fiscal 2023, so this is a busy holiday season ending January 27. It says total sales to increase in the range of 5 to 7%, but again, this assumes comparable store sales to be down as much as 2% or flat. So again, it's leaning heavily on new store openings to drive this growth. So it's interesting that during even the holiday season, even though it's an off-price retailer, potentially more attractive than big box retailers, that it's not expecting positive comparable store sales growth. So that's a bit interesting in there, that even though supposedly people might be more inclined to shop at Burlington because it's a cheaper option than other stores, it's still not expecting a whole lot of growth, even despite it saying that November's off to a good start. So a bit of a mixed message there, that I think it's a bit perplexing why the stock is up over 21%. I'm just not seeing anything really overwhelmingly positive besides the 5-year outlook where it's going to grow in the low double digits. So overall, I'm not convinced that it was worth a 21% jump or that there was something really that strong in the earnings numbers to suggest that. But let's take a look at the valuation. So actually, let's look at the 5-year stock performance. So as you can see, at 165 right now, it's about where it was 5 years ago. And if not for this big jump at 165, before that jump, it was at 136 a week ago. So on a 5-year basis, this stock would have been in negative territory. And so it hasn't been a great investment. Like, sure, it benefited from the boom in 2021 where there was a lot of spending in general in the economy. But since things have slowed down, it has been a bit of an underwhelming stock to buy. And with Burlington Stores, you need it to be a good growth stock because this is a stock that does not pay a dividend. So you're really only making money from the stock rising in value, and that's where you're gonna profit from holding on to it. One thing that is a bit concerning about it is that the stock's trading at a PE ratio of over 40, so 40 times earnings. Now let's take a look at some more detailed statistics because that just tells you their trailing earnings number, right? I like looking at the forward PE number a bit more because that tells you how the company might do in a normal year. Like they mentioned that they had some Bed Bath leases affecting its expenses there, and so when you see a forward PE that's a bit lower than the trailing PE, that tells you that the company's profits should improve over the next year. So maybe those some one-time expenses weighing it down, but even at 33 times earnings, I mean, a company that's leaning heavily on store openings and expecting even 10% growth. I mean, that's not an overwhelmingly strong growth rate. And 10% is decent for retail, but for a growth stock that's trading at over 33 times future earnings, that's a bit of a steep valuation for it. A price to book multiple of 13, PEG ratio, which again factors in the 5-year growth. PEG ratio is at 3. That's a bit high as well. So it doesn't look like an overwhelmingly strong deal here. The profit margin, again, this is a bit concerning at only 3%. It's fairly low, which is fine. There's businesses that have low margins. I mean, Amazon has low margins, but it does a ton in volume to make up for that. So, looking at this and looking at the company's forecast, it's tough to make a bullish case that the stock is going to go a lot higher, even though analysts have set a price of 195. It just still seems a bit generous. If we look at their earnings numbers here, you can see that trailing 12 months. I mean, this doesn't include the most recent results, but 265 million in profit off of more than 9 billion in sales. So I mean, their margins aren't that great, but the company does say that it's expecting that to improve. But overall, nothing really convincing here to suggest that Burlington Stores is an underrated stock or that it isn't overpriced, because its multiples are really high. The company's expecting a huge amount of growth for retail in Norway at 10%, and at the same time, it's leaning heavily on store openings, new stores. And in the short term, it's expecting trouble. Like in 2024, it's taken a bit of a cautious approach, but on a 5-year stretch, expecting growth to be 10%. It doesn't really line up. It doesn't really make a lot of sense, because how can you be more confident over the 5-year period than you are over the next 12 months? And so that's where I'd be a bit hesitant to rely on that kind of outlook, just because that seems a little overly optimistic, I guess, given that who knows how long the downturn might last, whether it's going to be a year, whether it's going to be a couple quarters, whether it's multiple years. So I think it's a bit too optimistic of an approach, and obviously analysts seem to believe it and are willing to up their price targets for it. But I think given its high valuation, its relatively low margins, and possibly overly optimistic forecast. I wouldn't buy Burlington Store stocks just because I think it's already trading a bit high for what it offers. And even if it does do a bit better next year, I would just be surprised if this stock continues to go up. Even though this hasn't been a great year for Burlington, I mean it's still overvalued, and it's just not a stock I would buy. There's no dividend, valuation is high, and yeah, I don't, I'm not a believer in the company's outlook. I think it's a bit too optimistic, and so while it's a good company, it's posting some decent results. I think it's just not a good buy right now.